This exact wealth window has only opened 3 times in the last 25 years. When it does, it creates a sharp divide. One group of people gets incredibly rich, while another group gets wiped out and never recovers. It is happening again right now, in 2026. Before we go any further, let me make one thing clear. I am not selling you anything. No course, no Discord, and no paid signal group. My only goal is to show you the data. By the end of this video, you will know exactly what separated the winners from the losers during the last windows, and where the same pattern is forming today. If you want to make sure you do not miss this, stay until the end, and hit the like button, so more people can catch this before the window closes. At its core, this comes down to a simple mechanism called a market cycle. This is just a repeating pattern where periods of high fear cause prices to drop, followed by a long recovery. It happens roughly once every decade. These moments are rare and dangerous. Most people only get 3 or 4 of these windows in their entire adult lives. Missing just one of them can be the difference between retiring early and working for the rest of your life. In this video, we are going to compare past windows to what is happening right now. We will walk through 3 real-life case studies of how people built massive wealth during these shifts, and then I will show you exactly where the current window is opening today. To understand how these windows work, we have to look back at the moments that created them. The first major event we need to examine is the 2008 financial crisis. This was one of the biggest economic meltdowns in history, and it was triggered by what is known as the subprime mortgage collapse. If that sounds complicated, it is actually quite simple. A mortgage is just a loan from a bank to buy a house. A subprime mortgage is a loan given to someone who has a higher risk of not being able to pay it back. The whole crisis followed a very clear chain of events. It started with cheap credit, meaning banks made it incredibly easy and cheap for almost anyone to borrow money. Because borrowing was so easy, banks started giving out millions of bad loans to people who could not actually afford them. This massive rush of buying quickly created a housing bubble, which means home prices shot up way higher than they were actually worth. Eventually, the bubble had to pop. People could no longer make their monthly payments, and they began losing their homes. Because banks held all of these bad loans, the banks themselves ran out of money. This triggered a historic bank collapse, which quickly turned into a total market crash. Suddenly, panic spread everywhere. People watched their investments shrink, and the average person was terrified of what would happen next. But while most people were focused only on the fear, a small group of patient investors recognized that this was the exact moment a generational wealth window was opening. They knew the crash was not the end of the world, but rather the beginning of the next great cycle. When the dust finally settled, the sheer size of the damage became clear. The S&P 500, which tracks the biggest companies in the country, dropped by about 57% from its highest point to its lowest point. This was not a slow slide. It was a vertical drop that erased trillions of dollars in market value in just a matter of months. The pain did not stay on Wall Street either. It quickly hit everyday families as businesses scrambled to cut costs. The unemployment rate doubled, shooting up to hit roughly 10%. This meant millions of hardworking people suddenly lost their jobs and had no way to pay their bills. Panic was the default setting for the entire country. Most people assumed the economy would bounce back quickly, but recoveries like this take time. It actually took until about 2013 for the market to fully climb out of that hole and reach its old highs again. For nearly 5 years, people who panicked and sold their investments at the very bottom were left with nothing but losses. But for those who understood the 10-year cycle, this long, slow recovery was the opportunity of a lifetime. While the crowd was frozen in fear, smart investors were quietly buying up top-tier assets at a 50% discount, setting themselves up for the massive bull market that followed. This brings us directly to what is happening right now in 2026. The next great wealth window is starting to open, and the first major trigger is a massive shift in how big technology companies are spending their money. For the past few years, artificial intelligence has been the biggest story on Wall Street. Every major tech company rushed to spend hundreds of billions of dollars building massive data centers and buying advanced computer chips. But recently, the mood in the market has completely changed. Investors are starting to look at these enormous bills and ask a very uncomfortable question: when are these investments actually going to make a profit? This worry about high spending has triggered serious volatility across the tech sector. People are realizing that these companies are pouring trillions into infrastructure, but the actual money coming back from AI today is still relatively small. Because of this anxiety, we are seeing sharp pullbacks. During recent earnings announcements, even the biggest tech giants saw their stock prices slide. In fact, tech-heavy indices like the Nasdaq 100 recently suffered a steep drop of over 4% in just a 2-week stretch. This sudden drop is creating a huge amount of fear, and many short-term investors are panicking and selling their shares. But just like in 2008, this volatility is not a sign that the world is ending. Instead, it is the exact mechanism that causes high-quality growth stocks to go on sale, marking the first major phase of our new 10-year wealth window. The second major trigger happening right now is interest rate and inflation uncertainty. This situation feels incredibly similar to the pattern we saw just before the 2008 crash. Back then, the Federal Reserve had spent years raising interest rates to try to cool down the economy. By 2007, all of those rate hikes had made borrowing very expensive. As a result, credit tightened in 2007, meaning banks started making it much harder for normal people and businesses to get loans. Fast forward to 2026, and we are watching the exact same story play out. The Federal Reserve has kept interest rates high for a long time to fight persistent inflation. Just like in 2007, the pressure is starting to show. Credit is tightening again in 2026. Major banks are quietly reducing credit card limits, tightening their lending standards, and making it harder for everyday borrowers to get access to cheap money. At the same time, inflation is still proving very hard to defeat. Unexpected events, like rising energy costs, keep pushing prices up and making the Federal Reserve hesitate to lower rates. This creates massive uncertainty in the stock market. Investors are constantly guessing whether interest rates will stay high, go up, or finally come down. When credit tightens and rates stay high, it acts like a slow squeeze on the entire economy. Businesses stop growing, consumers spend less, and a lot of weak companies start to struggle under the weight of their debts. To the average person, this uncertainty looks like a reason to panic and pull their money out of the market. But to a seasoned investor, this is history repeating itself. It is the final setup before the deck gets reshuffled, creating the massive discounts that make the next wealth transfer window possible. This leads to a massive problem for the institutions running our economy. The Federal Reserve is completely stuck, and they find themselves trapped in a dangerous dilemma. On one hand, they could cut interest rates to help the economy. Lower rates would make borrowing cheap again and help struggling businesses grow. But if they do that too fast, they risk letting inflation spiral out of control. On the other hand, they can choose to hold rates high to keep fighting inflation. But keeping rates high risks slowing down the economy so much that it triggers a massive recession. There is no easy way out. This is not just a guess. The biggest financial minds in the world are warning about this exact trap. The International Monetary Fund, or IMF, recently pointed out this delicate balance in their April 2026 World Economic Outlook. They explained that global inflation is actually projected to rise to 4.7% in 2026, largely driven by energy costs and supply disruptions. Because of this persistent inflation, the IMF warned that central banks must carefully manage these difficult trade-offs. If they make the wrong move, they could accidentally trigger a sudden financial market correction. When the very people in charge of the money supply do not know which way to turn, the market gets incredibly jumpy. This institutional panic is what causes normal investors to pull their money out and hide. But as we have seen before, this exact confusion is the catalyst that forces assets to misprice, opening the door for the patient investor to step in and capture the opportunity. To see how these choices play out in real life, let us look at a story about an investor we will call Mark. In 2008, Mark was just like millions of other normal people. He had worked hard, saved up, and had $50,000 invested in the stock market. But when the housing market crashed and the news became filled with panic, Mark got terrified. Every day he watched his account balance go down, and he felt like he was losing control. To protect what he had left, Mark decided to sell all of his stocks and move his entire $50,000 into a basic bank savings account. He told himself he was just playing it safe and would buy back into the market once things calmed down. This felt like a smart, safe move at the time, but it turned out to be a huge mistake. Because Mark was waiting for a safe time to invest, he ended up sitting on the sidelines for years. He missed the entire recovery. A decade later, in 2018, Mark looked at his savings account. He still had his $50,000. On paper, he had not lost a single penny of his original savings. But in the real world, he had actually lost a massive amount of wealth. Over those 10 years, inflation kept rising. The cost of groceries, rent, cars, and gas all went up. Because cash loses value over time, Mark's $50,000 in 2018 could only buy what about $40,000 bought back in 2008. By panicking and sitting out of the market, Mark did not protect his money. He actually guaranteed that his wealth would slowly shrink while missing out on the greatest market recovery of a generation. Now, let us look at another investor we will call Dana. When the 2008 crash hit, Dana did not panic and hide her money in a savings account like Mark did. Instead, she decided to buy safe haven assets. She put her money into gold, because everyone on the news was saying that gold is the ultimate safe place to hide when the economy falls apart. At first, Dana's strategy worked incredibly well. As the stock market kept dropping, the price of gold shot up. While other people were losing half of their portfolios, Dana was actually making a profit. She felt like a genius. But there is a catch to this strategy. The safe haven trade was only a short-term winner. Once the worst of the crisis passed, the economy slowly started to heal. The stock market bottomed out and began a massive, historic climb. But gold did not keep up. Because gold does not grow or build products, its price flattened out and eventually dropped. Over the next 10 years, Dana's investment underperformed the stock market by a massive amount. If she had put that same money into high-quality companies when they were cheap, she would have multiplied her wealth several times over. This shows us a very important lesson about these wealth windows. The obvious trade, buying gold or other safe assets because you are scared, is rarely the long-term winner. True, generational wealth is not built by hiding from the storm. It is built by buying the actual engines of the economy when everyone else is too afraid to touch them. Finally, let us look at a third investor named Priya. When the 2008 crash happened, Priya did not panic like Mark, and she did not chase after safe haven assets like Dana. Instead, she chose a very simple strategy. She kept investing her money into a diversified index fund every single month, regardless of what the scary news headlines were saying. An index fund is just a basket that holds hundreds of different top companies all at once. Priya knew that trying to pick individual winning stocks during a giant crash is incredibly difficult. So she just bought the entire market at a massive discount. When stock prices dropped by 50%, she did not see it as a loss. She saw it as a massive clearance sale on the best businesses in the world. Her strategy required a lot of patience. For the first couple of years, her account balance did not look amazing. But because she kept consistently buying when prices were low, she accumulated a huge number of shares. When the market finally turned around and began its long recovery, her wealth skyrocketed. By the time the market fully recovered a decade later, Priya had multiplied her wealth while minimizing her risk. The big takeaway from Priya's story is simple, but it is a rule that almost everyone forgets. Building real wealth is not about trying to pick the single perfect asset or chasing the newest hot investment trend. It is about understanding why prices are moving and knowing when that reason stops applying. During a crash, prices do not drop because great companies suddenly become worthless. They drop because human beings get scared and rush to sell everything all at once. The moment you realize that fear is temporary, you understand that the discount is your real opportunity. If you can stay patient and keep investing when everyone else is panicking, the 10-year cycle will work for you instead of against you. So where is the actual opportunity opening up right now? If you want to build real wealth, you need to look at the areas where the crowd is too distracted to pay attention. The first area is AI infrastructure. This does not mean buying the hyped-up software companies that everyone talks about. Instead, it means investing in the physical build-out, the actual power grids, cooling systems, and data centers that keep AI running. These physical systems are absolutely essential because AI requires an incredible amount of electricity. In fact, experts at Gartner project that global data center electricity use will jump by 26% in 2026 alone, making power security the ultimate priority. The second area is undervalued dividend and value stocks. These are solid, established companies in basic industries like energy, finance, and consumer goods that pay you cash just for holding their shares. While investors are busy panic-selling high-priced tech stocks, these steady businesses are quietly trading at major discounts. Right now, even with all the market noise, earnings for these steady companies are forecast to grow by about 18% annually, offering a safe place to grow your money and collect cash. The third area is real estate positioning. This means looking at housing and commercial properties before interest rates begin to drop and stabilize. Buying property while rates are still high is difficult, but it allows you to negotiate lower prices before everyone else rushes back into the market. Analysts at Morgan Stanley forecast that as rates normalize, average mortgage rates could drop to around 5.5%, which will eventually trigger a massive wave of new buyers and push property values back up. The fourth and most important area is developing your own high-income skills. This is the process of learning specialized abilities, like financial analysis, digital creation, or managing new technology that businesses are willing to pay top dollar for. Your personal skills are the only asset that inflation cannot touch, and they serve as the foundation for your entire investing journey. Research shows that learning a single in-demand technical skill can increase your average yearly earning power by over $20,000, giving you the extra cash you need to fund your investments. These four areas are where the next 10-year cycle is quietly beginning. While the rest of the world is staring at the daily stock charts in fear, the smartest move you can make is to start placing your bets on these long-term winners. Of course, we have to be honest here. Nobody can predict the future with 100% certainty. There is always a chance that things do not play out exactly like they did in the past. For example, inflation could stay high for much longer than we expect, or the economy could slide into a deeper, longer recession before it finally gets better. There is always a risk that the market takes longer to recover this time around, but you do not need to guess the exact bottom of the market to win. The smartest action step you can take right now is to use a strategy called dollar cost averaging. This simply means you invest a set amount of money into diversified index funds on a regular schedule, like every single month, no matter what the market is doing. This takes the emotion out of investing. When prices are low, your money buys more shares. When prices are high, you buy fewer. It is also a perfect time to review your portfolio exposure, which just means making sure you do not have all of your money sitting in only one or two risky tech stocks. A decade from now, we will look back at 2026 as a major turning point. When that time comes, will you be the one who took calm, steady action while everyone else was panicking? Or will you be the one still waiting on the sidelines when this window finally closes? If you want to keep tracking these cycles and learning how to build real wealth, make sure to subscribe to the channel and hit the like button. Finally, please remember that I am not a financial advisor. This video is for educational purposes only, so always do your own research before making any decisions with your money. Stay patient, stay consistent, and I will see you in the next video.